No, I think we have some good visibility what we will see in the next 6 months. Definitely we are going to see big trades of debt pools in Spain. Some are public, some are not so public, but definitely we are seeing big interest about buying debt to banks, mainly normally international lenders, although some Spanish lenders are active as well. We are starting to see in the core segment total change of attitude from lenders coming back to the market selectively, but now we are selling an asset, core asset in Madrid, in Castellana, and apart from having 20 offers from equity players, you also receive maybe 15 offers from lenders, 10 offers from lenders that were not there 3 months ago. Obviously they are going down into the margins as well, and I think that's going to create a trend in the core segment, not generally across the board. So these two trends I think are very clear. I don't know if there are only other comments from the rest of the panel.
Well, I'm actually doing something strange. I'm looking at the glasses on the table, and I see that we've got some which are empty, some which are fairly full, and one which is kind of half full. So I'm the one in the middle here.
Half empty or half full?
Exactly. The reason I'm saying is, if you take a very optimistic view, then there should be a lot more players in the market on the debt side, a lot more diversity heading into the US model. Rapidly emptying his glass. If you look at it the other way around and say, actually, the banks are coming back and they're going to be really powerful in their offerings, then you're heading into the half-empty glasses. We're retracing our steps back to 2007. And I really do worry about it, because the lack of diversity is what caused the significant amplitude of displacement. That's the drop from peak to trough in 2007, 2008 in the property market, because of the massive volatility that bank lending introduces into the real estate return equation. So I'm really concerned. You know, we stand, as I said earlier, at a crossroads. It's up to us as an industry to decide, do we want to have a rich, diverse funding source market, which then everybody can play in, or are we looking to go back where we were and create the inherent instability of the market of previous times?
I will only add to that, which I share your opinion, that it is a very different, I think, case when you are looking at economies that are seen as in a situation that can generate rental growth, because they have substantially addressed, rental compression in the last years. That economies that are seen as, either more stable or even adjusting downwards rentals. I think the picture is totally different. This is the dynamic thing. We are not talking about bonds. We are talking about, cash flows that are changing in time. That is a key element of when you underwrite for equity and for debt as well. So overall, that is a concern. But I think it is, as you said, it is important to segment, because I think in some cases, in some economies, it's yet to be seen if they are going to grow and at what rate. But if the assumption is right that there is going to be growth there, and the assumption is right that we are in a kind of lowest point in the cycle for years, then it's a very safe place in order to take moderate loan to values, and to lend. It's probably one of the best situations going to be lending there. So I think that's also another element to consider.
No? It's interesting. The debt market is following very much the sort of what's happened in the general real estate market and things. I think the bit of concern looking forward is the people chasing returns and where they move to. And we're seeing an element of this coming into the debt market, lending on more secondary type of assets and things. I would be sounding smaller levels of caution in certain markets to say that perhaps the weight of capital, whether that be equity or debt, is starting to drive certain areas into sort of pricing that brings quite a lot of risk with it. And therefore, I think a lot of financial institutions, whether they be debt funds or banks, will have to be mindful and cautious about where they deploy their capital. Because I think that the sheer weight of money has in some secondary areas, because one of the, going back to Adolfo's point, is okay lending into where you've got occupational demand, real underlying fundamentals working for the real estate, but actually there's a lot of markets out there and a lot of assets that will trade over the next few years as a result of banks deleveraging themselves. They're actually in areas where actually the fundamentals are not recovering very quickly and are unlikely to do so in the near future. So my bit is like everything, is to say whether it's equity or debt, is to be cautious, and stock selection is key to making sure you don't expose yourself to too much risk.
Well, yeah. I mean, no.
Quickly,
very quickly.
time. I think we'll be
my view is that there is more and more risk transfer to the lenders, clearly, and so I mean we're moving up, the LTV ladder. We experience, margin compression. I think somehow I would say alternative lenders and especially insurance companies, because it's still a nascent industry and they've got a lot of alternatives and it constitutes a very small part of their business, would tend to be more disciplined than traditional lenders, frankly. Yeah. And my fear is that banks are a bit pushing harder than other lenders, and I would love to live in a world where people think as one industry, etc. But you will always find one guy standing out and pushing harder to get the deal done. So my fear is that we are slowly, and that's a real concern in terms of financing sources diversification, that we are slowly but surely heading back. I mean it's cyclical obviously, but going back to a point where the risk borne by lenders is not necessarily reflected in the pricing as well, and the balance between equity risk and lending risk might at some point no longer be there.
But, I basically agree with your concern. I think it's a real concern, but I think the Basel regime, when that has been implemented, I think that will basically bring it back to a more normal or a new world where we have a more 50-50 of debt funds, insurance companies, which in many cases are better lenders seen from a risk perspective than banks that normally would be rather hesitant to take away assets if something is distressed. So
that you need to see banks rebuild their balance sheets to. That must be one of the reasons why the Basel thing has been pushed back, is because they don't want. It can't be implemented.
No, not really right now. It's easier to do that when the economies are rating. It was a difficult time to implement Basel regime, but I think eventually it will come.
Well, Adolfo, you've just come out of your recession, and you're going to go back into it in a few years' time.
Is our life?